Just to set the scene a little bit, I wanted to introduce Steve Bjornson. I think some of you talked about him earlier. He's our CFO. He's here today, so grab both of us for the rest of the afternoon if you can. Valeura Energy, we've been around for about 4 years. We're a TSX-listed company. Our market cap's about $39 million. And as Eric indicated, our main focus is Turkey. And basically, we're a pure play in Turkey, and we're a natural gas producer in the country. And what really distinguishes this is the kind of natural gas prices that we enjoy in Turkey. They're more than 3 times what you would see in North America. And in the fourth quarter, our average price realization was about $10.62 a BCF. We are a cash flow generating company. We produce a little under 1,200 BOE a day equivalent, which generates about $14 million in cash flow. Our netbacks, which is an indicator we use in the oil and gas business, is basically revenue less royalties, less OPEX. We generate about 45 bucks a BOE, or about $7.50 an MCF. And if you were to turn the clock back about a year ago in the oil and gas business, those are the kind of netbacks you might have enjoyed in the oil business. Well, we're capturing that with natural gas today in Turkey. We've got a big footprint in Turkey. We've established about 1 million acres gross, or about 420,000 acres net, and that's in a number of leases and production licenses. We do have cash on the balance sheet. Our working capital is about $10 million. Last year we generated about $14 million in cash flow, spending about $11 million. So we've been able to grow production last year about 23%. By spending our cash flow. There's no debt on the balance sheet. Our proved or 1P reserves value is about 78 cents a share, and contrast that with our current trading price, which is about 68 cents a share. So as we would look at it, we think that there's still some pretty good running room, obviously, in our share price. And if you looked at a most likely value, or what we call a 2P value in the business, proved plus probable, it's a little over $2 a share. So we're trading at relatively low multiples, and that's in part being an international player. For example, we're trading about 2.1 on our enterprise value versus discount debt-adjusted cash flow. Typical Canadian producers, probably 3 times that. So again, I say there's some running room there. And in our budget this year, we're planning to basically run it off cash flow and cash on hand, generate about 10 to 15% growth rate. And really this year is a transition year from Valeura from basically a non-operated joint venture arrangement for most of our production into 100% new, very large exploration license that we think's got tremendous potential, and we're going to get after it this year with 3D seismic and drilling. Just to say a little bit more about Turkey, and people sometimes worry about political risk. I would say this would rank pretty low for those investors that invest in the resource industries or emerging markets. It's a big country, 80 million people. It is a democracy. It's a founding member of NATO. And what's driving the high prices in Turkey is the fact that the country imports about 98% of their natural gas and about 92% of their oil needs, so highly dependent on imports. And 60% of their gas comes from Russia. From Gazprom at very high prices, $11.50 an MCF US, about 20% from Iran, which comes in at about $13.50 an MCF, and hence that's setting the kind of the price in that market in Turkey. If you look at IEA forecasts and so on, they're suggesting that the gas demand in Turkey could double over the next 15 years. What really attracted us to Turkey was not only the geology, but basically the fiscal royalty and fiscal regime is one of the best you'll find anywhere in the world. It's a straight 12.5% royalty rate. There's no other government involvement, which is very unusual. A 20% corporate tax rate, and we're not taxable because we're spending money. There's equipment available there. We're using mostly American equipment, but there are Turkish companies, so that keeps the cost structure low. Extensive infrastructure. We're putting on wells in about a week after we drill them. And the regulatory agency that we deal with is a very professionally run organization, not a lot of red tape, not a lot of worries about guys making decisions, very business supportive regulatory regime as I would look at it. And probably most significant thing to point out here is that there are no fracking restrictions in Turkey. And we fracked more than 70 wells in Turkey with no issues whatsoever. And we believe the country is one of those places in the world, like you hear from a lot of mining companies, that's basically underexplored and underexploited, was controlled for a long time by their national oil company, much like Mexico in terms of Pemex. So we think there's lots of running room left in the country. Just to focus in on our operations, which are on the northwest part of Turkey in the so-called European side. This is all west of Istanbul, about an hour and a half by highway, so we're about 1,000 kilometers from all the issues along the Syrian border. Our biggest asset are in those bright yellow lands, which is a joint venture that we're in with an American company, Transatlantic Petroleum. That's where most of our production comes from. I'll speak a little bit about 100% license that we own. It's an exploration license we picked up a couple of years ago that will start 3D seismic and drilling in 2015. We sell all of our gas from these lands to about 55 customers that are just to the north of us. We own all the gathering system, the sales lines right up to the plant gate of all these industries. So we own a marketing company and the midstream business. We're producing mainly methane, so it's all you do is dehydrate it, take some water out of it, but that's it, and compress it and sell it. So very low operating costs. What we've been active in doing since we've been in Turkey is basically and simplistically chasing shallow gas, very conventional stuff you'd see in Western Canada, very low cost to drill down to about 1,000 meters. And we've spent a lot of time and money looking at the tight gas plays below that, but that had been really never exploited in the past. We think the most attractive zone that in terms of what we'll focus on this year is this Mazarda Formation, which contains actually the source rock shales. So we're basically chasing gas in sands juxtaposed against the shale source rocks, much like the Montney Formation that you might have heard about earlier here this morning in Western Canada. We've fracked more than 70 wells. We've drilled more than 20 wells. We've 6 of those horizontal wells, the first horizontal wells drilled in this part of the country. And we've, as I say, fracked something like 70 wells in total. We've had some good luck recently in what I would call conventional exploration. And I just wanted to point out here, this is a program that we embarked on in the third and fourth quarters last year, kind of re-looking at the conventional gas business. We've had great success here. We developed about 9.5 million a day of capacity, almost 40% of our existing volumes. We found here in the fourth quarter. The largest discovery was at Gurgen, which is about 5 BCF of recoverable gas, and is right on the boundary of our Benarli license that we're going to be focusing on this year. And maybe I'll just jump to that. And focus on Benarli. This is the large license that we own. It's 485 square kilometers, so it's huge. It's only had 2 small shallow wells on it, very little seismic. We're going to do about 150 square kilometers of 3D seismic shown on that red outline and drill up to 3 wells later this year. Pursuing the same types of plays that we've been chasing on the joint venture lands. Plus, there's potential for a so-called basin-centered play when you get below about 25 or 3,500 meters, where there's, we think, good potential for overpressured reservoirs, which can make a big difference in terms of reserves and well capacity. That's kind of the blue sky case for us, is having success on that deep play. And what drives our economics and our ability to basically self-finance our work right now is, as I indicated earlier, very attractive operating netbacks. So, you know, our oil equivalent pricing last year on average was about $60 a barrel. Relatively low OPEX, about a little less than $7 a barrel. Our royalties are about $8, so our margin is about $45 a BOE equivalent. So very attractive. And what that does is, with those kind of numbers, and for example, tight gas wells, our cost structure here is quite low compared to a lot of these resource plays you would see in North America. For example, we can drill horizontal wells and frack them for about $2 to $2.4 million on a gross basis. So it's a relatively low cost structure in Turkey, given the depth that we're chasing and a relatively low cost structure in the country. And what that translates into, I won't dwell on this, but very attractive economics. You know, if you look at individual well economics, whether it's shallow gas wells, and some of these recent discoveries we made, they're basically shallow gas. They'll pay out in 6 or 7 months. On a multi-stage fracked well, for example, a horizontal well, anywhere from 14 to 20 months, depending on how much infrastructure you put in it. So it generates what we would call very attractive recycle ratios north of 3, where you're generating 3 times the value on, over your average F&D cost. So a very attractive business. So what I would say about us, we're in that pretty significant transition stage now from a non-operated but cash-generating company into more of a bigger e-exploration company on our own 100% license, with some potential from some really big upside with success. Thanks very much.